First item we'd like to look at are the holdings that are involved in your account. Obviously, given the positive market review from Jan and Randy, there may be few chances to capitalize on loss harvesting this year, but you may have individual stocks that were in a sector that didn't perform well and that could offer an opportunity to capture some losses. Also, we want you to consider what income you need to recognize from capital gains distributions from mutual fund companies. When they have appreciation in their stocks, they do send those out to the stockholders. So that is something that our investment team would be able to help you figure out as we get closer to the end of the year. A second consideration for your year-end planning relates to charitable giving. If you have highly appreciated stock from this latest market increase and you have charitable inclinations, you may consider gifting those stocks. You'd be able to recognize the full value of your gift without being subject to any capital gains taxes. The charity themselves would also not be subject to capital gains taxes if they are a 501c organization. On the same track, it may be beneficial for you to accelerate your gifting or deduction bunch. You can consider coordinating 2 or more years worth of gifting into 1 year, assuming that your donations would boost you above the standard deduction amount, and then you're able to capitalize on itemizing for the current year, and then subsequent year or years would utilize the standard deduction. The final thing related to charitable gifting is our qualified charitable distributions, or QCDs, which have become ever more popular. After age 70 and a half, and it has to be after age 70 and a half, it can't be age 70, QCDs can take funds from your IRA and send them directly to a charity. This eliminates the need for you to pay income taxes on those funds. Additionally, once you reach required minimum distribution age, any QCDs would count towards your distribution amount. The final consideration for year-end planning would be Roth conversions. They can be an extremely handy tool. By analyzing your current tax bracket and the potential consequences for conversions, you can determine if there will be long-term tax savings. This is especially key when considering what tax bracket your heirs will be in once they inherit your funds. It may make sense for you to do the conversion and pay the taxes now at a lower rate and let it grow tax-free as opposed to your heirs inheriting, especially given the secure rule that funds need to be distributed within 10 years. That concentrated amount of additional income can easily push heirs into a higher tax bracket, especially considering a lot of them are in their highest earning years. One caveat with Roth conversions, though, is to be conscious of how the conversion may impact your Social Security or Medicare taxation. Next, we want to work on monitoring and managing your taxable income. We want to look at years where you have higher than normal or lower than normal taxable income. We've already discussed the advantages of accelerating your itemized charitable deductions and managing your realized capital gains in the previous slide, but we also want to look at, is there a possibility of deferring certain income items, such as a sale of a business or exercising stock options. We also want to look at maximizing contributions to retirement accounts. Our next slide will show us the amounts that are available for 2024. If you happen to have lower than normal taxable income, this is where we would want to defer those itemized deductions so that we can just use the standard deduction for that year. We would want to possibly look at accelerating certain income items related to business sales or stock options, that type of a thing. And then we would like to also look at realizing some capital gains so that we're bringing up that cost basis to a more realistic level going forward. The final thing that we discussed in the previous slide was considering a Roth conversion. With all of these items, we highly recommend speaking with your tax professional. We're more than happy to coordinate with them, but this is definitely something that you need to work with them specifically on. Now we'll look at retirement contribution limits for 2024. For workplace retirement plans like a 401k or 403b, the 2024 limits are $23,000. If you're 50 or above, you can also do a catch-up contribution of $7,500. We did recently get the new numbers for 2025, and the only change is that the contribution limits for the 401k and 403b will be at $23,500. So there's only a $500 change for 2025. The other number that we like to point out is the contribution limit for IRAs is $7,000. So that's going to be combined between traditional and Roth IRAs. You're not able to do $7,000 separately with a traditional and $7,000 with a Roth. That has to be combined. For IRAs, there is a catch-up contribution as well. So if you're 50 and older, you can do an additional $1,000 per year into that. Those numbers did not change at all for 2025. We do want to point out that at the bottom of the slide, there is modified adjusted gross income limitations related to traditional and Roth IRA contributions that you need to keep in mind. So definitely, if you have the option to contribute to a workplace retirement account, this may be an option where contributing to a Roth may be a great way for you to get some tax-free growth out of your account. One thing to point out as well is that Roth conversions do not have any sort of income limitations. So this is a great planning tool. With Roth IRAs, there is a 5-year rule, and that means that earnings cannot be withdrawn tax-free unless the funds have been in the account for 5 years and you're 59 and a half. Also related to that are conversions, and every time you do a conversion, it starts a clock for a 5-year period. So if you do 3 years of subsequent Roth conversions, you will have 3 separate 5-year terms for those funds. And if you try and take any funds out of that prior to the 5 years, it would result in a 10% early withdrawal penalty. We also wanted to point out some of the highlights of the Secure Act 2.0. For those of you who are born 1950 or earlier, you know that you're currently taking your RMD. For those of you that were born 1951 to 1959, for you going forward, age 73 will be your RMD age. And for those who are born 1960 or later, your RMD age going forward will be 75. Previously, you may have heard that if you did not take your RMD, you did have a 50% penalty. So if your required minimum distribution was $30,000, you forgot to take it, you would have a penalty of $15,000. Well, this act did reduce that to 25%, and then they also put in a line as well that further reduces the penalty to 10% if it is being corrected in a timely fashion. So if you forget to take it, be sure you take it as soon as you can at the beginning of the next year to avoid some of those penalties. We also wanted to draw your attention to the fact that you can have some employers that have a Roth option within their 401k or 403b plans. This is definitely something we want you to be aware of, to talk with your tax professional about if this is appropriate for your situation. The main one that we wanted to point out that has had a huge change are related to 529 plans. Previously, some people were concerned about contributing to 529 plans because what if my child or grandchild doesn't go to college or doesn't spend all of the money in school-related form? Well, this rule changes it, and you can roll over 529 plans into a Roth IRA in the name of the beneficiary. There are some conditions to be aware of, so keep this in mind when you're debating on whether or not to contribute to a 529 plan. The funds have to be in the account for at least 15 years. Anything that you contribute in the previous 5 years is not eligible for a rollover. The rollover amounts are subject to the IRA contribution limits. So for 2024, that's going to be $7,000. And then the maximum lifetime availability for rolling funds over is $35,000. So you could, at this point, have 5 years of doing a $7,000 per year rollover from a 529 plan into a Roth IRA. The other thing to keep in mind with this is there are not any income caps on this. So this is a great option to choose if you are a high earner. We also wanted to point out that starting in 2025, there is an additional catch-up contribution available for individuals aged 60 to 63, where your total catch-up contribution would be $10,000. So that's something to keep in mind. If you are in those age brackets of 60 to 63, you can have additional funds put into your workplace retirement accounts. Now that we've gone through some of the specifics for retirement planning for this year, we just wanted to remind you of some of the general checklist for transitioning to retirement. One of the things you want to make sure to do is review what has changed. Obviously, the previous slides have shown the tax law changes that have come into effect. We know that keeping track of all this can be difficult, and that's what we're here for. We're here as experts, as a resource for you to be able to go through and help you walk through what laws affect your portfolio and your retirement planning. We also want to talk to you about your retirement goals. Has anything changed with that? Any changes with where you would be moving to or what you would want to be spending your funds on. Additionally, do you have anything that has impacted you via your health? If you have gotten a diagnosis or have something with longevity in your family that's changed, that's something that we want to address. We want to help you assess whether your savings are on track. So, is your current savings where we thought it would be at this point? Where can we increase our savings if we have a little bit of a shortfall? And then we need to determine if your retirement goals need to be adjusted. Maybe what you had anticipated being able to handle in retirement just doesn't agree with what your current spending needs are. We also want you to plan ahead. If you're getting close to retirement, review your Social Security benefits. We can help you figure out when is the best time to optimize your Social Security benefits. It will change for everyone. We also want you to make sure that you're keeping in mind Medicare planning. So speaking with a Medicare professional, making sure that you know what your costs are going to be and which plan will be best for you. And the one thing that we cannot stress enough is the fact that we want you to review your estate planning documents. We want to make sure you have those documents and that you're regularly reviewing them. We want to make sure beneficiaries are up to date. If you have a death in the family, if you have a divorce, if you have a new baby in the family, those are all instances where we want to review your estate documents to make sure that they fall in line with what your wishes are. We definitely have experts on staff here that can help you work through this, determine if you need a trust or if a will is sufficient, and also if there's any questions on your current estate planning documents. We have plenty of people who are more than willing to review them and give you some feedback on that. We do have a monthly newsletter called The Viewpoint, so if you'd like to sign up for that, feel free to scan the QR code below. We sincerely appreciate your time today, learning more about the market, economic, and your individual planning needs. We do have a team of experts here that are more than willing to help you at any stage that you find yourself in. Please feel free to reach out. Take care and have a great day.